Now let's turn to financials. They initially popped on the back of the Fed's rate cut, but then came off those gains. Still, financials have been gaining in the past 3 months, up more than 7%. The gains continue now that we got one rate cut with potentially more on the way. Joining us now is Gabelli Sykes, portfolio manager at Gabelli Funds. Mac, welcome. The KRE up there near 65. Can it keep moving higher if we get as many cuts as the Fed governors expect?
Well, it's a pretty exciting day today, and certainly a lot of cross currents in terms of politics, the Fed conference, et cetera. I think from our perspective in our investment process, we don't get too caught up in trying to predict the next 25 basis cut from the Fed or figuring out that. Although we do feel confident in the environment today and getting to a normalized yield curve in terms of the neutral balance in a couple of years. And what that means is a very healthy spread between short-term deposits and lending at 6%. And so that's a great environment for banks. And so over the next couple of years, we continue to think this yield curve and the environment that we're in will create significant tailwinds, and it's a great place to be investing.
Well, Mac, what about the difference between different types of banks here? How much does it matter how much consumer exposure a bank has, like, say, a Bank of America, or small business exposure like some of the regionals versus the M&A exposure in this environment?
Yeah, there's a lot to parse out there. I mean, and a lot of individual banks like Wells Fargo has just gone through a major catalyst with their asset cap. And certainly consumer at Bank of America, they're hosting an investor day, first time in many years, to talk about some of the good things going on there in November. So we've been focused on the bigger banks. We like the diversity of revenue. We like the capital market cycle. And we like the leverage to the asset values in terms of wealth and asset management. So those all continue to perform well. At the regional level, one bank we would highlight is First Citizens. We have a very entrepreneurial bank, great at creating shareholder value. Bought back 11% of their shares over the last year with still excess capital and a $4 billion buyback in place today with a $23 billion market cap.
So given what you said about the capital environment, does it favor banks like J.P. Morgan, Morgan Stanley versus a Bank of America or Wells Fargo, or no?
Absolutely. On the banking side, I mean, we've just seen the outperformance by Goldman Sachs, et cetera. So I think it's still a very healthy capital markets, announced M&A. We have an easier regulatory environment, as you know, across all industries. And so those strategics, sponsors, et cetera, are excited to get out there and form deals, et cetera. So I think that's a pretty healthy environment. We did hear from the CEO of Goldman Sachs last week, and he's very constructive on that outlook. So it definitely behooves those firms in terms of their entire vertical in IB, capital markets, and issuance. Are
you concerned at all about consumer credit?
So at the moment, it's always something to worry about actually going forward. And but we heard from American Express last week, pretty healthy trends there. Trust data at Capital One also pretty healthy. And then we had a pretty good retail sales number yesterday. So I think there are pockets where we've seen some stress, as we know, that's continued. But for the most part, we think it's a pretty healthy consumer outlook, and we see those trends at the big banks.